Who else has been refreshing this chart and literally feeling discouraged when you see that once more we are down 3% market cap? And even if you look further, let's go here. You see that for even in the last week, we're in extreme fear. We've been there last week. And even yesterday, today, we're in extreme fear at 14. So these things like this, and on top of all of this, we hear how US is sending their largest Navy ships to the coast of Iran, getting ready for wartime. We hear things like, despite the Supreme Court, US Supreme Court, literally undermining Trump's tariff frenzy, he still came and signed another executive order to put out even 15% now tariffs on top of everything else. So all these things are causing global uncertainties. And if we really get distracted, these are all distractions. War here, tariffs there, the markets there. Uncertainty, fear, doubts are all serving as distractions for us to lose sight on a bigger picture. What if I told you that what's going to happen from today and within the next 3 to 5 years has been laid out for us to see in real time? What if you knew exactly what's coming in the next 3 to 5 years? Exactly what's coming. Would you still sit down, complain, and be distracted by this noise? Or would you sit closer to the edge of your chair and pay attention and position yourself accordingly? Because this wave of wealth transfer will be one for the history books. It will be one that you'll be putting your grandkids at the foot of your feet and telling them stories about how you made the right moves, of how you conquered when everybody was trembling, when people were folding and selling out. You were confidently and bravely standing still because you knew what was coming. Well, Steve, that sounds all inspirational, but show us the receipts. And this is exactly what we love to do. We love to show receipts for our statements. So let's spend the time during this session to really go step by step and to underpin and to highlight the statement that we made. Let's look at exactly what's getting ready to happen from today to the next 3 to 5 years, and how we can position ourselves once more to be ahead of this wealth transfer that is getting ready to come, and to avoid all this noise and distractions that is keeping us in extreme fear that might cripple us, might cloud our judgment, and we might fold, sell out, and leave the market right before what we've been looking forward to achieve happens. So, as always, to kickstart, we always have to go back. You know, I love history. I'm a student of history. I love history. Why? Because that's where we learn everything. Nothing new is under this earth. Everything has already been done before. Everything has been experienced before. So if we are smart, we can always look over our shoulder and learn from the past. So let's kickstart. We're not going too far back. Let's start with 1944. What we're trying to signal here is that the US has always found a way to wiggle themselves and position themselves to be and maintain the global reserve currency. Always. And they've done this over and over and over again, and until they're specialized in it. They're experts at it. And this is what I really would like us to highlight. And this is exactly where we're headed towards. So everything started in 1944. To keep it short and sweet, what took place in 1944 was something known as the Bretton Woods Conference. And officially it was known as the United Nations Monetary Financial Conference. And it was a gathering, like we know, of 44 nations. They met on July 1st to 22nd in 1944 in New Hampshire, in Bretton Woods, right? So what do? They agreed upon a series of new rules after World War II, and so formed an international monetary system. This is the key word. A monetary system. In 1994, the takeaway, a new monetary system was put in place right after a disaster, right after World War II. And to make this even clearer, the takeaway here is that a new international monetary system was put in place by delegates of 44 nations. And this new monetary system was to place the US dollar as the global reserves as currency, because it held more than 70% of the global gold reserves. So the nations, 44 nations, agreed that the US dollar will be the dominant global reserve currency. Us 44 fiat currencies will be pegged to the dollar, since the dollar is the one that has the most gold reserves globally. Boom, 1944, that was the new monetary system put in place. New international monetary system put in place, engineered by the US. Now, second time that the US also came with a new monetary system was after 27 years. They found out that within 27 years, from the 1944 to until 1971, the gold standard was the basis, right? But now the US in 1971, led by the current president back then, Nixon, the United States unilaterally terminated the convertibility of the US dollar to gold. They got out of it, and this effectively ending the Bretton Woods system. So 27 years ago, in 1944, a new monetary system was put in place. Barely 27 years later, it was then debunked, and it ended that same monetary system. A whole new monetary system was put in place, however, just 2 years later, again by the Americans. And that took place in 1973. I hope you're keeping up. So in 1973, a whole new monetary system was put in place again. And this one was known as the petrodollar, right? What made it so special? Countries had to hold the US currency to purchase commodities, specifically oil. And we won't appreciate this until we understand the significance of oil, the importance of oil. Let's look at oil. So crude oil specifically is the most traded commodity globally, dominating both volume and value due to its critical role in energy, transportation, and industrial production. So this is, to this day, the most traded commodity in the world, and it's literally dominating. You don't often hear the word dominating if it comes to commodities or any other assets, but this one is completely dominating in volume and in value. So now that we understand the significance of oil, we might appreciate what the US did. It was an ingenious move. So they did that. What they did is this encouraged the purchase of US debt securities with the US cash reserves. So because in 1973, the US struck a deal with Saudi Arabia, and you were supposed to hold US dollar to purchase oil, and oil, like we just saw, being the most valuable commodity and most traded commodity in the world based on volume and value. Now you are supposed to hold US cash reserves. And with these US cash reserves, you are able to stake it, for lack of a better word. You had to purchase US securities to earn interest, to earn yield. So you didn't just want to hold on to the US dollar and lose your purchasing power, but you wanted to literally hold US securities, US treasuries, so that you can earn yield. So this put the US dollar in circulation globally, and it brought demand to US debts, right? This is a strategic system that created a continuous demand for the US dollar. And the Saudis agreed to the price of all their oil sale in US dollars only. So the only way to purchase this sought after commodity, you had to hold US dollar. That's it. If you didn't have any US dollar, there was no way you could put your hands on this precious commodity. This was a strategic system. The keyword is strategic. So this was the new monetary system that the US positioned themselves once more as the undisputed US global reserve currency, right? Because it created continuous demand for the US dollar. Now, this was in 1973. What happened between this 50-year time period? The US dollar accumulated a lot of debt, as we know, specifically over $38 trillion in dollars, and we've been experiencing a lot of other issues, challenges that we'll get to later on in this session. But the takeaway here is that a lot has changed since then, and we'll get to that. So now that we understand all of this, we've gone through two separate monetary systems. It started with gold standard at the Bretton Woods system. 27 years later, it was disbanded by President Nixon, and now it came to Petrodollar, 1973. And now with all these things happening, debt spiraling out of control, all of that, de-dollarization and the fear of the dollar going to zero and all of that, now they're coming up with a new system once more that is going to literally cement the US dominance once more globally. And this time it's going to do it even on a more sustainable way and a larger way and more dominant way than ever before in history of monetary systems. So the new monetary system that we're looking at right now is right in front of our faces, and it's called asset tokenization. This is going to transform the future of finance. This is going to change how we do finance forever. And what I want to highlight here is that the financial markets, this is plural, financial markets, and we look at them specifically, which specifically are undergoing a quiet revolution. And it's powered by what? By tokenization. So it used to be gold standard that saved the dollar. That's how it all started. In 1973, it became oil, a commodity. Now, fast forward today, and now as we speak, neither is it, it's now not a gold, it's not a commodity, neither is it, but now it's still a commodity, but this commodity is digital. It's a digital commodity that is an asset and a technology all in one, but we'll get to that. This asset tokenization could make investing more accessible, faster, cheaper, and more transparent. But this is where it really gets interesting now. And this is where tokenization really will fulfill its potential. And once more, the US went headfirst and threw in the Genius Act, right? So recent developments in the US regulation following Genius Act. Keep in mind, this is the World Economic Forum we're looking at. So these are literally the people that are dictating how the future of global economy is going to look like. And they're placing the future of global finance in tokenization and in US regulation, specifically Genius Act, specifically the digital US dollar. So this regulation is focused on digital currency, but the next phase of digital asset is focused on asset tokenization. This is where digital asset is focusing on tokenization. Tokenization is a huge deal, big deal. Now, this is interesting. This revolution, again, just like the revolution of 1944 at the Bretton Woods and the revolution at 1973 of Petrodollar, now this is the new revolution. But this time, it's not powered by gold or oil, but it's powered by asset tokenization. This is a concept that leverages blockchain technology to digitize and fractionalize ownership of what? Real-world assets. Like, remember when we discussed here, we were told that the financial markets are undergoing quiet revolution powered by tokenization. Markets, this is a plural. So let's look at those markets. Those markets community are bonds, stocks, bonds, and real estate. stocks, bonds, and real estate. You know I love the numbers. Let's look at the numbers, community, because without the numbers, nothing really makes a lot of sense. So, equities market, this is stocks. Its global market cap is valued at 70 trillion with a T. 70 trillion. That's just the global stock market. Now, the global bond market is topping out at 92 trillion. And now the real estate, it's a whopping 217 trillion, making it the world's most important asset class. And keep in mind, these are the three markets, global markets, that are getting ready to be tokenized. So we are talking about, for the math geniuses, already added these three numbers up. And yes, it's over $380 trillion. Why am I highlighting this so passionately? Is to make a point that the US found another way, just like they did in 1944, 1973, and now in 2026. BlackRock has identified Ethereum as the leading default standard for tokenized real-world assets. Keep in mind, stocks, bonds, real estate, over 380 trillion. And with the network supporting 66% of all assets in 2026, Ethereum supports over 66% of all tokenized assets. The CEO, and this CEO, Larry Fink of BlackRock, is also the co-chair at the World Economic Forum. So there's no coincidence. He is the CEO of BlackRock, pushing real-world assets on Ethereum. At the same time, he's the one who just set the agenda at the World Economic Forum that the future of finance is tokenized assets. And these tokenized assets and tokenization of real-world assets are taking place on Ethereum, which dominates more than 65%. He further says and emphasizes that there will be a common, this is now singular, one common blockchain positioned as Ethereum is necessary to reduce corruption and create efficient digitized markets, right? So he already, not only at the World Economic Forum, laid the groundwork and the blueprint that the future of finance will be tokenized assets, real-world tokenized assets. Specifically, he mentioned the stock market, the bond market, real estate, of course, and so much more, right? The stablecoin led by the Genius Act, which is stablecoin. Because how else will you provide liquidity for all these tokenized assets for over 380 trillion? It needs to be backed by or paired with something. And this is why the Genius Act came first. And US denominated stablecoins are dominating 99% of all stablecoins are US denominated. So all these stablecoins, tokenized assets, will be paired with a US denominated stablecoin, because US denominated stablecoin is the most liquid fiat, tokenized fiat. You can't pair these tokenized assets with the Swiss franc or with the yuan or with the pounds, euros also. You can't. It's just not as liquid right now on chain. So that's the whole point. And what this does, community, is complete dominance. Remember this word dominance. You don't use this word often. And if it's used, you need to take it serious. So infrastructure dominance, Ethereum is favored for its security. This is the most important thing. And as we will hear later on, this is what Larry Fink is stressing on. This is his main concern, security. This is the number one. Security is the number one purpose. And then, of course, decentralization, neutrality. No threats of tariffs, a nation sanctioning you or hitting you with tariffs or freezing your assets. No, it's neutral, it's decentralized. And this is another important factor, security and decentralization. And then, of course, developer ecosystem. Where you see developers, you see liquidity rushing. So serving as the backbone for institutional tokenization. And then BUIDL. BUIDL is a tokenized treasury. BUIDL is tokenized treasury. So BUIDL is already in place, which serves as tokenized treasury. The Genius Act covers stablecoins, which is tokenized US dollar. Do we see what's happening here? Let's take it a step back. I really want us to understand this. I really want us to understand this. If we take it a step further, we see that countries had to hold US currency to purchase commodities, which is oil. This encouraged the purchase of US debt securities, which is now BUIDL. This is BUIDL right now. And US cash reserves, these are USD denominated stable coins. So we see BUIDL, US debt securities, this is tokenized, and we see US cash, tokenized is stable coins like USDT, USDC. So we see BUIDL, USDC, or USDT. And this is the strategic system that created continuous demand for the US dollar and for US debt. Now that we know that, let's go back and look at the number. $380 trillion. Right now, that's like, right now, we saw Ethereum is at 200, roughly 250 billion in market cap. So even that means 1,000x if 100% of that liquidity would come on place. But let's not go 1,000x. Let's say only half of that, 50% of this. So roughly 190, let's say 200 trillion comes on Ethereum in terms of liquidity. Why am I saying that? Because the infrastructures are there already. BlackRock's BUIDL, which is, like we said, is a tokenized treasury, US treasury, launched directly on top of Ethereum. So the treasury is covered. It's already on Ethereum. The digital dollar stablecoins are already on Ethereum. So everything is lined up, set up already, just like, and these are the frameworks that are needed to bring demand to the US dollar. So if you want to use Ethereum, which is one common denominator, one common blockchain, you need to have the dollar, because even Ethereum is paired with the dollar. And if you want to trade and invest in these tokenized assets, you need the dollar, because these tokenized assets are paired with the digital dollar. And these stablecoin issuers, through the Genius Act, they're required to purchase US treasuries. And this is where BUIDL comes in. This is a digital version of the US treasury. Now, I love this beautiful chart right here. The toll road to tokenization, right? The rise of stablecoin adoption may be indicative of tokenization in action. And blockchains like Ethereum could be poised to benefit. You see here 65% of tokenized assets are on Ethereum. This is not wishful thinking. This is not just hype. This is the reality. Remember at the beginning of the session, we say that whatever is happening from today, between today, 3 to 5 years, everything is laid up right in front of our faces. And I hope by now we're seeing what's coming our way. Everything is coming our way right now. This is what's coming. So 65% of tokenized assets are already on Ethereum. This is a fact. This is not wishful thinking. This is just the reality of things. If we go back here, I want us to really understand something. Market dominance, like we say, with 66% of tokenized assets on Ethereum compared to the second best, 10% on Binance, Ethereum is viewed as having an unsurmountable lead. In other words, there is no way you can catch up to it. If the second best is almost 7 times behind you, and for those who love charts, let's go back to the chart. You see it much better on the chart. In black, representing 65% is Ethereum. In white is Binance, just 10%. And this is without the Clarity Act passed yet. The Clarity Act is not even passed yet. So the real tokenized assets are even yet to come. Meanwhile, the rails are already built, like we saw. So let's not just take this as Steve's word. Let's hear from the experts themselves. Let's hear from BlackRock and Larry Fink themselves. And let's close out with this before we go back and really look at things even clearer.
There was no question that the blockchain that we would start with our tokenization on would be Ethereum, right? And that's not just a BlackRock thing. That's really anybody who would enter this space. That's the natural default answer, right? That's really important.
All investments on a tokenized platform that you can move from a tokenized money market fund to equities and bonds and back and forth. We have one common blockchain.
There was no question that the blockchain that...
The keyword here is one common blockchain, and it's Ethereum. It's the standard of the future of finance. To summarize what we've discussed so far, in 1944, we saw that the US gave birth to become the new global reserve currency, backed by almost 80% of the global gold reserves. And that's how the US became the global reserve currency. Not even 27 years later, in 1971, the US then decided that they're getting off the gold standard because they were printing more fiat than they had gold reserves. And this made certain nations or central banks unease and wanted to get their gold, which they didn't want to run out of, and then they literally terminated that. And that was the end of the Bretton Woods system. Just barely 2 years later, a whole new monetary system was put in place in 1973. And this was focusing on again, the oil commodity. Commodity, like we saw, the oil is the most traded commodity in the world based on revenue, volume, and value. And you were required to use the US dollar to have access to this oil. And this was a strategic system to create continuous demand for the US dollar. Fast forward to today, just like we saw. Now, you see that not only oil now. Now, if you want to get your hands on equity, on stocks, if you want to get your hands on the bonds markets, if you want to get your hands on real estate, on commodities, on any form of tokenized assets, which combined will be even over $2 quadrillion, you need to be holding the US dollar. You'll need the US dollar. So this is even on a much larger scale. If you want to participate in the future of finance, which takes place on Ethereum, like we just saw, which dominates by over 65%. And if you want to be part of this, you need to hold the US dollar in terms of USDT or USDC. That's the only way you'll get your hands on Ethereum or on all these tokenized assets. And that's where we are today. But now there is a challenge. That challenge is known as liquidity. It's known as credit. To get all of these things going, we need liquidity. Where is the liquidity going to come from? That's the challenge we're faced with right now, community. And let's get right into it. The challenge right now, community, is unsustainable monetary system. We are sitting with a debt-driven monetary system right now. And this debt-driven monetary system requires liquidity to run. And if there's no liquidity to trigger it, there is no bull run. We are stuck in a bear market. We are stuck with high interest rates, no liquidity, stagnating markets, and that's not where we want to be. So we need to address the challenge right now. And like we always say, before we can appreciate the solution, let's look at the challenge right now. And this challenge comes with a big warning because the first major domino has already fallen. So a company known as, and to be specific, this is a private credit company known as Blue Owl Capital. It announced that it permanently, not temporarily like Nixon said, he is actually honest and said permanently halt redemption for Blue Owl Capital, right? It's 1.7 billion private credit. And who is suffering right now? Aimed at what? Retailers, retail investors, you and I. If you invested in this and you took credit from this, bad luck. You're shut out of this. You can't redeem, you can't take out any liquidity, and it's 1.7 billion from retail investors. So, and this is not a small thing either, because we are talking about a very large private credit company, and it has over 300 billion assets under management. And the reason, now this is the thing that we say that liquidity is key. The reason why they're permanently halting redemption, basically in a straightforward language, the reason why you can't cash out is because they're saying they have to manage their liquidity mismatch. Basically, they're in a liquidity crunch. They don't have liquidity. And it's, what is it caused by? It's caused by a surge of withdrawal requests. People want to exit. People want to cash out. But their withdrawal request caused the liquidity mismatch. They have no liquidity, community. So each time when we talk about we are solving real world challenges, this is what we mean. This liquidity crisis is real. So this is a $3 trillion challenge. It's a $3 trillion market right now. So this isn't just an issue for blue oil only. This is certainly not the case, right? This move permanently to restrict redemption is a signal for the broader industry in a $3 trillion private credit market. The credit market, the private credit market, is at $3 trillion. $3 trillion. And another thing that I want to highlight here is that roughly 40% of the direct lending companies, like this company itself, they have a negative free operating cash flow. They don't have any operating cash flow. They don't make any money. And actually 30% of this company, their debt is maturing next year. They're due to pay. They have to pay their debt. Well, where will that come from? They have no operating cash flow. They have no, it's negative. And 30% of these companies need to repay their debt by 2027, next year, making them extremely difficult to refinance. How will you refinance at a higher rate? The rates are still high. The rates are at all-time high as we speak. Now, the next thing is default. Default rates are even reached 4.5%, are only rising. Default are those who can't afford to repay the loans they took. And it's increasing. More people can't afford to repay. And downgrades of this is also happening, right? Downgrades of your score, of your credit score. So if the stress continues in the private credit market, it will first impact the small businesses as usual, for whom this private credit market is a critical funding source, right? And then it says here, additionally, it will cause refinancing costs to go up, obviously, because if you have to refinance, like next year, they're due. So if you can't repay the whole debt, you'll have to refinance. But because the interest rates are so high, that means before they had a, let's say, 3% interest rate or 2% interest rate, but because we had 5 now they have to pay 2.5 times more interest. And no bank on their right mind is going to give them or refinance them. And this will result in even more defaults, which will create a vicious cycle. We'll come back to this article. There's certain things I want us to really understand. Let's go back here. There's certain things I want us to understand if it comes to the default. Let's look at, first of all, what are defaults? What are the credits that are being defaulted on? The credits that are being defaulted on, there are 4 types. There are 4 types of credit. And the first one, obviously, is credit cards. Credit cards, right? And then there's installment loans like mortgages or car loans. And then, of course, these represent home equity loans. So these are the types: credit cards, installment loans like mortgages, and car loans. So this is exactly what's private credit is on. So these are the defaults. They can't pay back these they can be paid back because of the high interest rates like we saw. So rising credit defaults driven by high interest rates. The interest rates are just too high right now, and they're getting even higher. And then inflation. Inflation means you're losing your purchasing power. The salary you receive is not keeping up with inflation. Things are getting more expensive. Your money doesn't stretch as far as it used to last year or 2 years or 3 years ago. And then, of course, your savings are gone as well. So all these things are placing severe strain on both households and businesses. So car loans defaults have reached 15-year highs. So people that are leasing their vehicles or have their cars on loans, their defaults, those who can't repay it, have reached 15-year high. The mortgages, the same thing, delinquency, are also rising. People can't afford to pay their mortgages. This, of course, causes lenders to tighten the credit even more, credit access. And this, of course, triggers the credit crunch that we know. And these default rates remain, when the default rates remain high, we say interest rates are very high. And this, of course, is the impact on this $3 trillion credit market. So there's a $3 trillion credit market. In a nutshell, higher interest rates and inflation have left households less disposable income, leading to a rise in credit card and specifically auto loan delinquencies. And this is exactly what's happening. This is exactly what's happening. And to paint this picture even clearer, this puts us back like in the 2008, 2007 era. To make this worse, this private credit market is not even regulated. They say it's lightly. It's not regulated at all. And if you come down here, you see exactly what's telling you. When you see central banks are saying that they're concerned, obviously, why would they be concerned if they are being regulated? They're not regulated. That's why central banks are concerned. About what? About transparency, right? There's no transparency. If you're concerned about transparency, that means there is no regulation. Regulation for what? Valuation. That means these companies, like we talked about, they're all over leveraged. If you look at the top 7, like we say, the prices are going up based on the leverage they take, the loans they take from these private credit companies. So all these stock prices, even cryptocurrency, people take on leverage, and this causes overvaluation. So you look at the stock market, look at the commodities market, you look at the crypto market, you look at real estate market, they're all overvalued. And all that overvaluation comes from leveraging debt. Disclosure. So nobody has to, if you're not regulated, you don't have to disclose quarterly reports. You don't have to do that. But most importantly, liquidity. Here's where it really starts. Liquidity is the biggest challenge. Once more, this is a quadrillion-dollar problem right now. Liquidity. If you can solve this challenge somehow, you're in business. So let's continue again. So systemic concern. This is exactly what we need to understand. So another thing that I want to highlight why they're really not regulated is this right here. So before the private credit market shifted from banks, they were dominating 70%. So 70% of all private credit were issued by US banks. That was before the financial crisis. Now they dropped to only 10%. But now they got replaced by these companies like the one that just stopped people, investors, retailers from cashing out. And now it's 77% of them. 77% of these so-called private credit companies, like the one that just halted withdrawal, they are now leading and dominating by 77%. And they're the ones financing all these leveraged buyouts through debt financing globally. So all these assets are financed by these private credit issuers because the banks were being what? They were being regulated. were being now regulated. And now because of that, you see here, as banks decreased their lending activity, non-lenders took their place to address the continued demand for debt financing. This is a debt-driven monetary system. And without debt, without liquidity, this debt-driven monetary system can't work. So you see why we say liquidity is important. And since you can't generate, or you're not producing that liquidity, you're not retaining it, you just keep wasting it. You have to just keep piling up more and more debt so that you have access to liquidity. And this is what's happening. In the financial system, in the financial world, our monetary system is heavily depending, and there's a huge demand for debt financing. In other words, there's huge demand for liquidity, cheap liquidity. So when the US Security and Exchange Commission tightened restrictions and capital requirements on public banks, these so-called private credit companies took over and started dominating by over 77%. So now that we know that, I want us to look at something else. So this Blue Owl company, last week, it permanently shut the gates on one of those funds. Now, what's happening is that they're preventing investors from withdrawing their cash every 3 months as they'd previously been allowed to. So they've completely shut it down. You can't cash out, no more. What's happening now is that they've now begun selling assets to return to investors. Keep in mind, you can't sell real estate on the spot. You can't sell gold on the spot unless it's ETF, paper gold. And you can't sell stocks because it's weekend. So what's going to be sold easily? What's the easiest thing to sell on a weekend? This, right? You see articles like this. So Satoshi Era Whale exits after 15 years and dumps 750 million in Bitcoin. So they dumped over 11,000 Bitcoin worth 750 million, closing a position that had remained untouched since the network's earliest days. So this is very alarming. So one of the OGs, one of those early day investors of Bitcoin, cleared all of their Bitcoin, liquidated all of it, probably related to this right here, because now they have to sell all the assets. You can't sell real estate. It will take months, if not years. And nobody's buying real estate right now because the interest rates are just not in favor right now. You have to wait until it goes down. Like we said, stocks, the markets are only Monday to Friday. So you have to wait. And the easiest asset right now is cryptocurrency. It's trading 24/7. So that's exactly what happened. And this is also, if we come here, we see exactly what took place. Right? Now we can understand what took place here. You see, when there's not enough liquidity and such a huge sale comes in, you see that big red candle. And this is exactly what takes place. So community, let's continue. So its latest sign, this is a $3 trillion market, like we say. And what I want us to understand is this is being compared to the run-up of the 2008 financial crisis. It's the exact same thing. Those that were issuing the credits were the banks in 2008, but now it's this so-called private credit companies. Same thing, they're not being regulated, just like the banks were not being regulated back in 2008. And now the red flags. The red flags is that it's very similar to the 2007, 2008, like we say. And what's happening here is that the liquidity. Liquidity is the problem. And how big is that problem? It's because there's a mismatch. This mismatch is between what investors believe that they own, right? Investors believe that they own something, and what they can actually exit. There's a big difference of what you believe. This the word is believe. You believe you own this amount, but actually, what can you actually exit? I'd like to make this point even clearer, community. Let's make this clear. Let's come here. Like this individual that just exited with 750 million. If we come here, we see that this is Bitcoin, the largest cryptocurrency in the world, sits at 1.3 trillion, and it has 1.4 billion in liquidity. So if you look at liquidity to market cap ratio, meaning that based on its market cap, it should be having $1 trillion, right? Because if people want to exit their liquidity, they can easily do so. And the closer the number of the liquidity to market cap ratio is to 100, the more liquid it is, the more safe this investment is. And if you do the math and you calculate the 1.4 billion and divide it by the market cap, you'll come to a 0.1%. So the liquidity to market cap ratio of the largest cryptocurrency in the world that is supposed to replace and be the next financial monetary system has a 0.1% liquidity to market cap ratio. Meanwhile, the number one crisis that we're faced with right now, and we've been talking about for the last hour, is liquidity. So 0.1% is the liquidity to market cap ratio. So that individual that exited 750 million, and there's only 1.3 billion here. So that means more than half of this liquidity would have been gone, and it would have been caused a lot of challenges for Bitcoin, especially its price. So what about the billionaires? There's Bitcoin billionaires. This is what they mean. There's a difference between what it shows, what you believe you own, and what you can actually exit. Those are two completely different things. You might be a billionaire on paper, but what can you actually remove? Right now, 10,000 or 11,000 Bitcoin is a 750 million. So right now, that's more than half of what this liquidity is right now. And this is exactly what you need to pay attention to, community. If we do another example, like with Bull Run right now, Bull Run's liquidity to market cap ratio is sitting at 462 in liquidity, 1.2 million in market cap. Liquidity to market cap ratio is roughly 38% right now, 38%. Now keep in mind, I want to highlight something. We don't have 35 or 36 billion in volume. If you would use this 35 billion in volume and take 3% of this to add on to liquidity, this would be $1 billion right now. You would have $1 billion added to the liquidity just within one day. But this is exactly what we're talking about. New cryptocurrencies right now need to be able to retain liquidity. If you don't, we'll end up exactly like this company that just started the domino effect. You'll end up just like this company that just started the domino effect. If you don't retain liquidity, this is what's going to happen. You'll be forced to halt withdrawals. You'll be forced to halt withdrawals. And why? Because there's a liquidity mismatch. That's a beautiful one. That's a nice way to put it. It means that if you want to withdraw, if you get withdrawal requests, people want to exit, you can't. You just can't. And this is what they call a mismatch between what investors believe they own and what they actually can exit. So you might be a billionaire or a millionaire on paper, but if you can't exit it, what's the point? If you have 10,000 BRL tokens right now at $1.29, so let's say roughly that's 13,000. There's enough liquidity for you right now to exit. There's no problem whatsoever. But if you have 10,000 Bitcoin right now and you want to exit, you take away half of the entire liquidity with you. because you don't work on retaining liquidity. So this is what we're saying, community. And this is very, very important. This number one wallet right now, it's a contract, as you can see. It's a smart contract. It's a staking contract. It's the staking platform. And right now, over 72%, exactly 72% of the total supply is staked. 72% of the entire total supply is staked. Now, keep in mind, if we were to have that 35 billion in volume like Bitcoin had, right now at 3%, because we retain 3% as liquidity, that will put $1 billion in our liquidity pool. Meanwhile, there is no sell pressure because 72% of the supply is staked. And these people that are staking are receiving sustainable USDC distributions. So they are busy accumulating USDC staking rewards. They don't think about selling. Meanwhile, liquidity keeps accumulating. And on top of that, this is Uniswap. This is where our tokens are traded. It's also a smart contract. It's a smart contract, as you can see here. This supply, meanwhile, is shrinking because this is where the supply is being removed. This is where the banning takes place. And we started with 1 million in total supply. How much do we have now? Our total supply shrinks with every trade. It used to be 1 million. Now it's 959,000. So over 40,000 BRL tokens have already been banned and removed from the liquidity pool. So as the supply is shrinking and the stakers keep staking and receiving USDC distributions, liquidity is being retained so that just in case these stakers want to liquidate, want to exit, there is enough liquidity. But meanwhile, with so much staked and liquidity being accumulated, eventually there'll be so much more liquidity than people even willing to exit or desiring to exit, because we have a sustainable staking reward system that gives out in stable coins. And even these stable coins that this 72% are receiving, not all of them are just going to use it in the real world. Let's say even just half of them are using half of it and compounding the rest. That alone will bring back even more volume. With more volume, the supply will shrink even more. And if the supply shrinks, it makes the remaining tokens more valuable. And as the staking rewards become more permanently, more stakers are going to stake. As more stakers stake, the more secure and stable bull run becomes. As it becomes more stable, right here, like we said, the supply is being banned and removed from here, making bringing more valuable to the token. And liquidity is also being accumulated, attracting even more investors, more traders that are purchasing and staking even more. And you see how this vicious cycle comes into place. So instead of having a vicious cycle that is literally, it's not here. Instead of having that vicious cycle, community, let's look at this. What is the solution? Let's look at the solution now. The only way to stop this, right, this vicious cycle of negativity, the only way to stop this is by first lowering interest, lower the interest rates, and what? Provide liquidity. That's the only way you can solve this. So why wait all these years to now? The way you provide liquidity is by going through these private credit companies. Why don't you retain your own liquidity? Why don't you build an ecosystem that is retaining liquidity with every trade? Community, this is why we always stress on liquidity. It's a challenge, it's a problem. And the only way to stop this vicious cycle, community, is you have to do two things: lower interest and provide liquidity. This is probably why the Feds pumped 18 billion into the economy overnight, as more entities are experiencing what? Liquidity crunch. This is a real challenge. And if we never understood this, I'm sure now we understand. So, but this amount, 18 billion, it's too small. It will never stop the stress in the private credit market. Keep in mind, this is a $3 trillion market. So 18 billion is nothing but a drop in the ocean. And the Fed would have to go full dovish, or the dominoes will continue to fall. So this is how we're going to close this session, community. Remember, we started the session by telling us that, what if I tell you that we know exactly what's coming the next 3 to 5 years, exactly what's coming. We started with the monetary systems, 1944, 1973, and now this is the new monetary system. It's called tokenization of assets. It's going to take place on Ethereum. It's told to us by the World Economic Forum, by Larry Fink, who is the co-chair of the World Economic Forum and the CEO of BlackRock already. They're pushing the narrative of tokenizing assets. That's the future of finance. 65% of that takes place on Ethereum. This means that 380 billion of the tokenized assets, like we saw with the stocks, bonds, real estate, takes place on Ethereum. And what's coming? There's only one way. There's only one way to stop this. So what's coming in the next 3 to 5 years? Guaranteed lowering of interest. Actually, it's coming May. May, the new chair is coming to replace Jerome Powell with one agenda only: bring down the interest rates. You have to bring it down. If not, it's going to affect the entire industry, because the credit crisis affects all markets. Commodities are bought with credit. Real estate is bought with credit. Retailers are defaulting. They have credit debts, car loans, mortgages, all on debt. Cryptocurrencies like Bitcoin are being bought on debt. Everything is being bought on debt. So if they don't get a grip of this vicious problem, the only way to get a grip on it is, first of all, lower interest rates near zero, and then let the money printer do what it needs to do by providing liquidity. Why is this so important to us? Where will this liquidity come from? It will come and will be pushed by these tokenized assets, the tokenization of assets. And we're looking at, just with these 3 major asset classes, which is stock market, bond market, and real estate, we're looking at over 380 trillion. And imagine, even just 10% of that is already 3 trillion. So if that pushes Ethereum that much, which is already dominating by 65%, like we see here, they're undisputed number one. What's coming between now and the next 3 years is massive liquidity. Massive wealth is taking place, community. So all these tariff wars, Iran-US war, China-US back and forth, all these Epstein files, all these things that are happening are for us to obviously be distracted. And all this refreshing of CoinMarketCap website and discouraging us, and all these extreme fear indices, let's not get carried away with it. Let's not lose focus. Let's stay focused and understand that what's coming between now and the next 3 years is massive liquidity. And it's coming to one blockchain specifically. One. And it's called Ethereum. This is not Steve talking. This is the World Economic Forum, led by Larry Fink, that is the co-chair of the World Economic Forum, and BlackRock. The infrastructure is already built. They're in place. BUIDL is the tokenized version of treasuries, and stablecoins are the US dollar themselves. And just like back then, crude oil was the most traded commodity globally, dominating both volume and value. Now, tokenized assets will be the most traded commodity globally. That will be dominating both in volume and value. All that takes place on Ethereum, and 2 of our tokens are on Ethereum, and even our bull run staking platform is on Ethereum. So let's get ready for that flood. But the difference is your ecosystem needs to address and have a system to retain that liquidity. And this is how we're closing out. With all that volume that is coming, you need a crypto, you need a blockchain to be part of the blockchain ecosystem, specifically Ethereum. And you need to have an ecosystem within that Ethereum that is doing specific things. First and foremost, you need a system that will be banning your supply and removing it from the total supply. So the more it's adopted, the more trading volume, the more valuable it becomes. Secondly, you need to retain your liquidity. Why? We just discussed the importance of liquidity. There's a liquidity crunch right now. And in order for people to have access to this liquidity, they're taking on leverage. And this leveraged, these companies that are issuing this debt are going out of business because they themselves don't even have an operating cash flow. So the market makers that provide liquidity can't give you liquidity anymore because they're going out of business. So do you see the importance of an ecosystem that is literally retaining liquidity? I hope so. The third one is sustainable staking rewards. As more stakers are staking to secure and stabilize our ecosystem, you need to give them sustainable staking rewards. And as these individuals are staking, 72% of our supply is being staked. Meanwhile, 3% of liquidity is being retained. So the longer these individuals are taking advantage of the stable and sustainable staking rewards, the more our volume is used to retain even more liquidity. And the supply is also being banned. So as these individuals are staking, their token becomes more valuable and more liquid. They don't have to worry about being frozen or unable to exit. If you can address liquidity challenge, inflation challenge, and sustainable staking rewards challenge, you are literally addressing a quadrillion-dollar market challenge. Community, let's get ready for what's coming. We see what's coming the next 3 years. We see what's coming between the next 3 to 5 years. Whatever the case may be, let's prepare, and we are already ready for it. We have an ecosystem that is built specifically for that. So with that said, community, I want to wish you all a beautiful rest of the day. Until we meet again,